The key to navigating these costs is a proactive strategy. And that's where personalized planning becomes absolutely essential.
I'm Dr. Alexander Reed, and my mission is simple: helping you protect both your health and your hard-earned savings as you navigate retirement.
Last year, the average senior in this country handed the IRS money they were never required to pay, not because they cheated, not because they were lazy, but because nobody, not their bank, not their insurance agent, sometimes not even the person who filed a return, ever told them about 3 deductions sitting in plain sight on the federal tax code. I'm going to put a number on it, because vague scares nobody and a clean number wakes you up. A retiree paying ordinary Medicare premiums, a supplement plan, and out-of-pocket dental and hearing costs can sit on $6, $8, even $10,000 a year in qualifying health expenses, and walk right past the deductions that turn those expenses into real tax savings, year after year. And here's the part that should make you sit up straight. The window to fix it doesn't stay open forever. This filing season, before the April deadline, is when you either claim what's yours, or you let it go and start the clock over. So here's the stakes laid out flat. If you miss these, you don't just lose money on paper. You lose money you could be spending on the very thing that's getting more expensive every single year of your life. Your health, your prescriptions, your premiums, the dental work you keep putting off, the hearing aids you've been thinking about. Every dollar you overpay the government is a dollar that isn't protecting your body or your nest egg. And that's the spiral we're going to break today. Here's my contrarian promise, and I mean it. The conventional wisdom, just take the standard deduction, it's simpler, don't bother with the rest, is quietly costing a huge number of seniors real money. Simple is not the same as smart. In the next few minutes, I'll show you exactly what the 3 deductions are, why they work, who they're for, and precisely what to do before this window closes. Stay with me, because the second one is the one almost nobody claims, and for some of you it could be worth the most. Let me tell you who's talking to you, so you know why you should listen. My name's Ray Hollis, and I'm the resident retirement tax strategist here on this channel. I've spent more than 30 years sitting across the table from people exactly like you, folks who worked hard, saved carefully, did everything right, and then walked into retirement and got quietly clobbered by a tax code that nobody ever taught them. I've reviewed thousands of retiree returns, and I'll tell you the thing that still makes my jaw tighten. The mistakes are almost never exotic. They're not some loophole only the rich know about. They're basic, boring. Sitting right there, deductions that a tire preparer skipped or a piece of software didn't ask the right question about. The money was always yours. Nobody just reached out and handed it back. Now, before we go one inch further, the honest part. This is a wake-up call, not a personalized tax plan. I'm not your CPA, I'm not your financial advisor, and I'm certainly not your doctor. What you're about to hear is education and general information, accurate, mainstream, the real rules, but your situation has details I can't see from here. So treat this as a nudge that gets you pick up the phone. Before you act on any of it, run it past a licensed tax professional who knows your numbers, and keep your own doctor in the loop on anything health-related. Nothing in this video is a reason to change a single thing about your prescribed care. The goal is the opposite: to free up money so you never feel pressure to cut corners on your health in the first place. If that sounds good to you, do me one favor and tap subscribe, because this channel exists to put this kind of money back in your pocket. Now, let me show you the machine, because this isn't bad luck. It's a predictable cycle, and once you see it, you can't unsee it. And you'll feel a lot smarter than the people who never figured it out. Here's how it works. It always starts with health. A fall, a diagnosis, a heart thing, a knee that finally gives out, and suddenly the bills arrive. Premiums you didn't budget for, a supplement plan, prescriptions that cost more than your first car, a stay somewhere, some help at home. That's stage 1. The health event creates the cost. Stage 2, the cost forces a money move. You pull more out of the IRA than you planned. You take a bigger distribution. Maybe you sell something. And here's the cruel little twist nobody warns you about. Pulling that money out raises your income on paper. Your adjusted gross income climbs. And when your income climbs, more of your Social Security can become taxable, and the bar you have to clear for certain deductions rises right along with it. The very act of paying for your health can quietly raise your tax bill. Stage 3, it compounds. Higher income this year can mean higher Medicare premiums down the road through the income surcharges. The bigger tax bill means you pull out even more next year to cover it. And around it goes. A health event becomes a cost. The cost becomes a bad-feeling money move. The money move raises your taxes. The taxes force another money move. That's the health wealth spiral. It is not random. It is a machine. And the 3 deductions we're talking about today are 3 of the cleanest brakes you can put on that machine because they let the tax code share the cost of your health instead of punishing you for it. Let me make it human, because numbers on their own don't keep you up at night. People do. I want you to meet Margaret. Margaret's 68. Now, Margaret's a composite. She's stitched together from the real situations I've seen over the years. So don't go looking for her, but understand that everything that happens to her happens to real people every April. Margaret retired at 66. She and her husband had a plan, a paid-off house, a modest IRA, and one beautiful goal: 2 weeks in a condo in Florida every winter, the trip they'd promised each other for 40 years. Then Margaret's health turned. Nothing dramatic at first, a knee replacement. Then her hearing went, then the dental work that had been fine for now suddenly wasn't, added up across 1 year. Her Medicare premiums, her supplement plan, the prescriptions, the hearing aids she finally bought, the dental implants, the mileage driving back and forth to appointments 40 minutes each way. By the end of that year, she'd spent somewhere north of $9,000 out of her own pocket on health. And here's what cut me when I saw her file. She took the standard deduction. Simple, easy. The software didn't push back. And in doing it the simple way, she never tallied those $9,000. She never even knew that a chunk of it was deductible. So she paid the IRS as if she'd had a healthy, cheap year, in the most expensive health year of her life. The Florida trip? They skipped it. Just this once, she said, to save money. Money that, in part, the tax code was willing to give back to her if anyone had told her how to ask. That's the part that stays with me. She didn't lose that trip to her knee. She lost it to a deduction nobody mentioned. Don't be Margaret. Not because Margaret was foolish. She wasn't. She was doing exactly what she was told. Be the person who knows the 3 things she didn't. Let's go get them. Here's the first deduction, and it's a foundation, the medical expense deduction, what it is in plain English. When you itemize your taxes, the IRS lets you deduct your out-of-pocket medical and dental costs, but only the portion that goes above 7.5% of your adjusted gross income. That 7.5% line is the floor. Spend below it and you get nothing. Spend above it, and every dollar over that line counts. Now, why does this matter for both your health and your money? Because seniors, more than any group alive, are the ones most likely to clear that floor and the least likely to realize it. Here's what nobody's telling you at the doctor's office. A huge list of things you're already paying for counts as a qualified medical expense, and most people leave half of them off the pile. Your Medicare Part B premiums, the ones pulled straight out of your Social Security check, the ones you barely notice, those count. In a recent year, the standard Part B premium ran $185 a month. That's $2,220 a year, just on Part B, before you've paid for a single pill. Your Part D drug plan premium counts. Your Medigap supplement premium counts. And those can run $100 to $300 a month on their own. Your dental work, your vision, your hearing aids, they count. Long-term care insurance premiums count, up to age-based limits. Even the miles you drive to your appointments count at the IRS's medical mileage rate, plus parking and tolls. Even certain home modifications for a medical reason, a wheelchair ramp, grab bars, widening a doorway, those count too. Let me give you the arithmetic punch, because this is where it gets real. Say your adjusted gross income is $60,000. 7.5% of that is $4,500. That's your floor. Now suppose in a heavy health year, you racked up $9,000 in those qualified costs, premiums, dental, hearing, the lot. $9,000 minus your $4,500 floor leaves $4,500 in deductions you can actually take. That's $4,500 knocked off your taxable income on top of everything else you itemize. For a lot of seniors, that's hundreds of real dollars back in your hand. Money that came from health costs you'd already paid anyway. Here's the precedent, and it's solid, not invented. That 7.5% floor used to be a moving target. For years, the threshold bounced around. There was a stretch where it was pushed up to 10%, which made this deduction nearly impossible to use. Then Congress made the 7.5% floor permanent. That's a documented, settled change. It means you can finally plan around it with certainty. The lower floor is here to stay, and it tilts the math in your favor more than it has in over a decade. So here's exactly how to act on it this week. Open a folder, a real paper folder or a file on your computer, I don't care which. Pull your Medicare summary, your supplement plan statements, your pharmacy printout, your dental and vision bills. Add them up, all of them. Then take your adjusted gross income from last year's return, multiply it by 0.075, and that's your floor. If your total is anywhere near that line, even close, you do not want to take a standard deduction without checking whether itemizing beats it. That's the one calculation that would have saved Margaret her Florida trip. One important guardrail for me. You can't double dip. If you paid an expense out of health savings account or had it reimbursed, it doesn't count again here. And whether itemizing actually beats your standard deduction is exactly the kind of thing a tax pro can confirm in about 10 minutes. But you have to bring them the folder. Nobody builds that folder but you. Right now, before you forget, open your bank app or your Medicare statement and just look at what you paid in premiums last year. I'll bet the number is bigger than you think. Write that number down. We're going to use it. Now here's the second one. This is the one almost nobody claims. And for some of you watching, this could be the most valuable thing I say all day. This is a self-employed health insurance deduction. And before you tune out because you think, I'm retired, that's not me, stop. Listen closely. Because the definition of self-employed here is wider than you think. And this is the insider reveal that the standard advice completely skips. Here's what they don't tell you. If you have any self-employment income in retirement, and I mean any, you may be able to deduct your Medicare premiums in a completely different and frankly better way than the first deduction. Do you do a little consulting? Did you pick up some freelance work? Do you sit on a board and get paid for it? Do you sell something on the side? Do handyman work? Do a bit of bookkeeping for an old client? Run any little thing that earns a profit? If money comes in and the IRS sees you as running a trade or business, you may qualify, and here's why it's better. The first deduction, the medical one, makes you itemize and makes you clear that 7.5% floor first. This one does neither. The self-employed health insurance deduction comes off above the line. That's tax speak for. It lowers your adjusted gross income directly before any floor, and you can take it even if you take the standard deduction. No itemizing, no 7.5% hurdle. You can deduct up to 100% of your Medicare premiums, Part B, Part D, your Medigap supplement, even Medicare Advantage, straight off your income. Now think back to the spiral I showed you. Remember how pulling money out raises your adjusted gross income, and a higher income drags more of your Social Security into the taxable column and can push up your future Medicare surcharges? This deduction lowers that very number. It's not just a tax cut. It's a brake on the whole machine, lowering your AGI ripples outward and protects you in 3 or 4 directions at once. Here's the precedent, because I never want you taking my word for something this good without backup. This isn't a gray area. The IRS issued formal guidance years ago confirming that Medicare premiums of every part, A, B, C, and D, qualify for this deduction when you're self-employed. It's settled. It lives on Schedule 1 of your federal return. It's real, it's official, and it has been for over a decade. Let me hit you with the arithmetic. Say you're a retiree doing a bit of consulting, and your Medicare premiums and supplement add up to $4,500 a year. With this deduction, assuming your little business turned a profit at least that big, you can take that whole $4,500 off your income above the line, even while taking the standard deduction. No floor to clear. For a lot of folks, that's several $100s saved every year on premiums you were paying no matter what. And here's the kicker that makes people gasp. If you've been doing self-employment work for the last few years and never took this deduction, you can generally amend your returns going back up to 3 years and claim it retroactively. 3 years. That's not a typo. People recover real money doing this. Money the government was perfectly happy to keep until somebody asked for it back. Now, the fine print, because I respect you enough to give it to you straight. There are real rules. Your deduction can't be bigger than the profit your business actually made. No business income, no deduction. And you can't claim it for any month you were eligible for a subsidized health plan through an employer, including a spouse's employer. Those conditions matter. And this is precisely where a good tax professional earns their fee. They'll know in one conversation whether your situation fits. But here's my point. If you got any self-employment income, and you've never even asked a question, you might be walking past this every single April. Don't. So here's your action step this week. Ask yourself one question and write the answer down. Did I earn any income last year that wasn't a pension, wasn't Social Security, and wasn't an investment? A check for consulting? A 1099 from anyone? A side business, however small? If the answer is yes, that's your homework. Take that answer and the Medicare premium number you wrote down earlier to a tax pro and say 5 words. Do I qualify for this? That's it. That one question could be worth more than everything else in this video combined. And listen, do me a favor. Down in the comments, tell me, do you have any self-employment income in retirement? Yes or no? Saying it out loud, typing it where you can see it, is how you turn, I should look into that, into actually doing it. The people who comment are the people who act. Now here's the third deduction. And this one is brand new, it's enormous. And a stunning number of seniors don't even know it exists yet. For the tax years right now, and only for a limited window, there's a new bonus deduction just for people 65 and older. If you're 65 or older by the end of the tax year, you can take an additional $6,000 off your taxable income. $6,000 per person. So if you're married and both of you are 65 or older, that's up to $12,000. $12,000 knocked off the income the government gets to tax you on. Now you might be thinking, Ray, that's not a health deduction. And technically you're right. But stay with me, because I put it third on purpose. This is the money that pays for your health. This is the breathing room. When you spent a year worried about premiums and prescriptions, and whether you can afford the dental work, a deduction this size is exactly what frees up the cash to cover those costs without raiding your savings. It's the difference between paying for your hearing aids out of fear and paying for them out of comfort. That's why it belongs in this conversation. Here's what makes it so good and so easy to miss. It stacks. This new $6,000 bonus sits on top of the regular standard deduction that almost everyone takes. And it sits on top of the additional standard deduction that seniors 65 and older have always gotten. That's another roughly $2,000 for a single filer, more for a couple. And this is the part that trips people up. You get the new bonus whether you itemize or take the standard deduction. It is not one or the other. You don't have to choose. Most seniors who simply take the standard deduction can pile this right on top and never lose a thing. Let me show you the stack, because seeing it laid out is what makes it click. Picture a single filer, 65 or older. They get the regular standard deduction. Call it around $16,000. Then the long-standing additional senior amount, about $2,000 more. Then the new bonus, $6,000 more. Add those up, and you're looking at well over $20,000 of income the IRS simply doesn't get to touch. For a married couple where both are 65 plus, the combined number climbs past 40,000. That is a wall of protection around your money, and a big piece of it is brand new this year. The precedent here is as official as it gets. This is federal law, passed and signed, and the IRS itself has published guidance telling seniors to check their eligibility. It's not a rumor. It's not a maybe. It's on the return. But, and this is the part that costs people, it does phase out of higher incomes. The full bonus is there for single filers up to a modified income of $75,000, and for married couples filing jointly up to $150,000. Above those lines it shrinks, and high enough up it disappears entirely. There's also a small handful of requirements. You need a valid Social Security number on the return, and married folks generally need to file jointly to get it. Details, but details that a tax pro handles in their sleep. So here's your action step, and it's almost embarrassingly simple. Make sure your return actually claims it. If you use software, Make absolutely sure you've entered your date of birth correctly and check the box that says you're 65 or older, because that little box is what unlocks both the old senior amount and triggers the questions for the new bonus. If someone prepares your return, ask them directly by name, "Did you apply the new senior deduction on my return?" Make them say yes. Do not assume. I have seen returns where a checkbox got missed and thousands of dollars walked out the door over a click. And here's the urgency that's specific to this one. It's a temporary deduction. It exists for a limited set of years, and then it's scheduled to go away. So the years to use are the years you're in right now. This is not someday. This is a closing window. Right now. Open last year's tax return, the actual document, and look at the top. Find where it asks about your age or has the 65 or older box. Did somebody check it? If you can't tell, that's your answer about whether to make a phone call this week. Okay, you've got the three. The medical expense deduction, the foundation, the self-employed health insurance deduction, the one almost nobody claims, and the new senior bonus deduction, the brand new wall around your money. Now, let me give you the systematic plan. Because 3 good ideas you don't act on are worth exactly nothing, and I refuse to let you be the person who nods along and does nothing. Here's the sequence. Don't panic. Don't try to do it all in a weekend. And for heaven's sake, don't make any dramatic money moves out of fear. We build a calm system, step by step, so that emotion never gets to drive. This week, this is the only urgent part. Build a folder. One folder, physical or digital. Into it goes. Last year's tax return, your Medicare and supplement statements, your Part D and pharmacy printouts, your dental, vision, and hearing receipts, any long-term care premium statements, and a single sheet of paper where you've written your adjusted gross income from last year and the medical premium total you tallied up earlier in this video. That's the whole job this week. Just a folder. Next, do the one calculation. Take your adjusted gross income, multiply by 0.075. Write that floor number next to your total medical spending. Now you know in 30 seconds whether deduction number 1 is even in play for you. If your medical total is near or above that floor, flag it. Then, answer the self-employment question in writing. Yes or no. Did I have any income last year that wasn't a pension, Social Security, or investments? If yes, circle it. That's your ticket to deduction number 2. Then, confirm the age box. Pull up the actual return and verify that the 65 or older box is checked and your birth date is right. That's deduction number 3, protected. And finally, within the month, while filing season is open and the deadline is real, take that folder to a licensed tax professional or sit down with your software with all of it in front of you and go through the 3 deductions one at a time. Itemized versus standard for the medical, the self-employed question for the premiums, the senior bonus confirmation, 3 check marks. That's the whole system. Write it down. Make it concrete. Put the steps on the front of the folder if you have to. Because here's the truth about money decisions in a health crisis. When you're scared and tired and the bills are stacking up, emotion takes the wheel and emotion makes terrible financial choices. A written system, built calmly ahead of time, is how you make sure that when a hard year comes, you're following a plan instead of reacting to panic. That's the entire game. Now, I know exactly what some of you are thinking right now, because I've heard it across the table 1,000 times. So let me get ahead of the voice in your head. The first voice says, "This sounds complicated. Maybe I should just wait, do it next year, deal with it when I have more energy." Here's the cost of that. Every year you wait, you don't just lose this year's savings. You potentially lose a year off that 3-year window to amend and recover what you already overpaid. Waiting isn't neutral. Waiting has a price tag, and it's bigger than the hour it would take to build a folder. The second voice says, "But my advisor never mentioned this. My tax person never brought it up. Surely if it mattered, somebody would have told me." I want to be gentle here, but honest. The person who files a return is often working fast, through a stack of clients, answering only the questions the software puts in front of them. They are not sitting there hunting through your life for every dollar you could save. That's not a knock on them. It's the reality of how it works. Here's what they don't tell you at the bank or the tax desk. Nobody is more motivated to find your money than you are. Nobody. The deduction nobody mentioned is still your deduction, but you have to walk in and ask for it. And that's the thing about all three of these. Most people watching this video are going to nod along, think, good to know, feel a little smarter for 10 minutes, and then do absolutely nothing. They'll file the same simple way they always have. They'll take the standard deduction without checking. They'll never ask the self-employment question. They'll never verify the box. And next April, they'll overpay all over again, and they'll never even know it, because the money you never claimed doesn't show up as a loss. It just quietly stays gone. Don't be most people, because here's where the window actually is. This filing season, right now, before the April deadline, is when these get claimed or lost. Not 5 years from now, not eventually, this season. And that brand new senior bonus? It's temporary by law. The years to use it are ticking by. There's a real closing window on the table in front of you, and on the other side of the math only gets worse. Health costs rise every year you age, and a deduction you didn't claim is gone for good unless you move fast enough to amend. So here's the binary, and I'm not going to dress it up. The seniors who act on to protect their health and their wealth at the same time. They let the tax code carry part of the load. They keep more of their own money, and they walk into the next hard health year with breathing room instead of dread. The seniors who hesitate pay for it. They overpay the IRS, they raid their savings cover gap, and they skip the Florida trip just this once. Over and over, year after year, for money that was theirs the whole time. You already know which one you want to be. So here's what I want you to do, and I want you to do it the second this video ends. Turn off this video. Go find one thing, your last tax return or your Medicare statement, whichever's closer, and start the folder. That's it. That's the first action. Not the whole plan, just the folder. Start today, because in 6 months, you're either going to thank yourself for the cushion this built, or you're going to wish you had. And by then, another filing season will have slipped past. And do me this last favor, because it genuinely helps you and it helps the next person who finds this channel scared about money. Drop a comment and tell me which of the three surprised you the most. Was it the medical floor, the self-employed Medicare deduction almost nobody claims, or the brand new senior bonus? Saying it out loud is how you make yourself act on it. If this gave you even one number you didn't have before, hit that like button so it reaches another retiree who needs it, and subscribe so the next time the rules change. And they always change. You hear it here first, in plain English, before it costs you. You worked your whole life for this money. Let's make sure you keep every dollar the law says is yours.